And welcome, May 6th. Welcome Home Radio, your real estate lending and learning show. Hope everyone in DFW enjoyed the Blue Angels flyover 11 a.m. this morning. That was awesome to see. And so thank you for those first responders, nurses, doctors, firemen, police. Appreciate all the efforts in this pandemic time. This is your mortgage market update for May 6th. The ADP employment numbers came out this morning, and we're in line with expectations. Now, those expectations were unfortunately very high at 20 million plus job losses. Looking deeper into the service sector is hit the hardest with 16 million jobs. And next, the small companies with fewer than 50 employees were next at 6 million job losses. The latest forbearance numbers data came out as well. 7.54% of all mortgages, or roughly over 5 million mortgages, have gone into forbearance. And if historical data shows anything, 2/3 of those will never come out a year from now. Unfortunately, that will be a challenge as the industry moves forward. The MBA released their mortgage applications, and surprisingly, mortgage apps were up 0.1%. And for the third straight week, purchase applications were up 6%, which is quite a surprise. Or is it? Prior to the pandemic, the housing market was a boom due to strong demand and tight supply. And of course, those living in apartments are looking for space, distance, which should be increased demand for housing. One of the biggest drivers home buying is having children, and we may expect a lot of childbirths over the next year. The current low market rates may be an opportunity to purchase a home at an attractive price for the future. And that's why our discussion today. Today, we're going to be discussing loan applications and what key things are in the process so that everyone understands what an application is made up of and what we look forward. And of course, with me today, Alan Pace with Keller Williams. How are you, sir?
Doing great, Blair. Man, good to see you again. And that was a wonderful opening, the Blue Angels. And they didn't quite fly right over my house, but from the front yard, I could see at a distance towards the DFW airport that they were doing their thing. And thank you to all the frontline folks out there, doctors, nurses, whoever you are, firemen, police.
To be honest with you, I was totally surprised at how many people stopped and waited. I mean, from about 10:45 till about 11:10 here in Frisco, I mean, the world stopped. Everybody got out of their house, out of their car, stopped their car, everything. I mean, it was just amazing that they took the time and to enjoy that. Kids were out running around, parents taking pictures of them. It was a tremendous moment, and I appreciate the military and the Blue Angels doing that. As I understand it, they're flying down to Houston right now and then going to hit New Orleans before their day is over. So quite a road trip for them today.
And that ought to be fun down in New Orleans, because by that time, everybody will probably be a little tipsy. That'll be fun.
Hey, I'm really excited about today's show because the opportunity to buy, just from my experience, and we were talking a little earlier, pandemic, and I never stopped working. I literally never stopped. And to be honest, the last 10 applications, 8 of them are purchases, not refis. Well, that's an inverse of what the market is doing, because the largest 3/4, 3 of every 4 are refinances right now, but people are looking to purchase. And to understand what an application is made up of, the opportunity that it is, and how to be prepared for it, I think is really the discussion that we want to get clear today. And there's 4 parts. There's 4 critical parts. And the 4th area I'm going to hit first, just because it's one that we don't discuss as a pre-approval process. It's one when you get involved, is the actual collateral. The home they're buying, they're putting the collateral up or the home up as collateral for the loan. So we're not going to discuss quite that one, but we're going to talk about the other 3 areas. And every loan officer, every lender looks at things the same way. They may have different topics. And so the first one I want to hit on, the first thing that we touch on, is credit qualifying. What do you think that means to you, Alan, when somebody says credit qualifying?
Well, it means they better do it, or I can't even show them a house. So you have to, the first step in any home purchase is, unless you have cash, is to go to Blair, get pre-approved. He'll look at all, he'll tell you what he's going to look at, but basically he's going to look at everything in your background credit-wise, job, income, debt ratios, things like that. And he's going to say, you can afford this, you can afford that, you can't afford this, that kind of thing. Then he creates a letter of pre-approval or pre-qualification. And once I or a realtor gets a hold of that, then we can show our clients homes with the understanding and full confidence that if we get them under contract, find them the right home, Blair's going to come through with their loan.
That deal is going to happen. So yes, credit qualifying, really what it does and looks at is, one, your credit scores. And I want people out there to understand that credit scores are vastly different because there's 13 different algorithms, now 14 being with Vantage, different algorithms out there showing up a score or a number. You go to the free credit report, you get a free credit report. It's not, it doesn't have any numbers because it doesn't have an algorithm they're running. It's just trade lines for you. What's on your credit report from the bureaus, you get that free. But if you get a report with a number, that means either one, if you ask for it, it should be in the industry you're looking for, auto loan, insurance, credit card, educational loans, or a mortgage. Those are all different types of algorithms, and they should have a score. And that score is going to be based on that algorithm and the data at the bureaus. But if you're looking for just your credit information, you're not going to get a score. Credit Karma, one of the largely used free sites that you keep up with your information, that is actually 6 months old data. It's actually based on the revolving credit card algorithm. So in looking at that, it's going to be vastly different than the standard for the industry of lending, which is utilize FICO's 2004 standard. That is the Fannie, Freddie, Ginnie, VA, USDA standard. Now the bureaus are trying to force or want us to start using what's called Vantage score. And that does a little different. It's actually, it takes away the medical debt and deletes all that, and it gives a different score. Plus it also weights differently than a FICO 2004. And unfortunately, the industry standard is still FICO 2004. So we want to understand and look at that, but that's not the only thing we look at is the credit score. With the tightening up of the industry, many lenders require 640, 660, 680, 700 to do their mortgages right now. But we're not just looking at that. We're also looking at your historical data. First off, do you have a mortgage? Do you have a secondary or a HELOC or an equity lien, something along that line? Do you have investment properties? We're also looking at how much credit you've been looking for in the recent months. What type of credit? We also see if there's any bankruptcies, public records, divorce decrees or delays.
So Blair, I got a quick question, buddy.
Yeah.
When you're dealing with clients, sometimes first-time home buyers, happens.
Yep.
And you talk to them about getting in touch with their lender, or whoever to get started. If a client does not submit everything, I get asked this a lot. Do you have ways of finding things out that they don't tell you about? They might not mention the foreclosure. They might not mention the child support. They might not mention they have hidden money somewhere in a 401k or whatever. It happens. We're human beings, and everybody's got a different background. So
sure. Can
you address that briefly?
That's a great question, and I appreciate it. Yes, there are things that we're going to find out if it has to deal with finance. Now, if you have mattress money, there's no way we're going to find that out. If you have a 401k, we're not going to find that out unless you share that. That's an asset. But anything dealing with your credit, anything dealing with your past experiences, bankruptcy, foreclosure, any of that is going to be stored on your credit report for up to and beyond 10 years. So again, that credit report gives us much information. Unemployment. One of the things I had historically, I had a young couple, very similar to what you just said, first-time home buyers coming in, and they knew that income was critical. So we go through the process. I double check all the income stability. I double check everything. But finally, during the loan process under contract, we find out she received 3 months of unemployment. Well, wait a minute. What she put on the 1003 was not, she didn't have 3 months of unemployment. But yet, coming back, she received from her taxes under her Social Security number Guess what? She received 3 months of unemployment. Well, what they had done is they actually went to their old company, got a letter verifying, hey, she was employed, was able to deliver that for that, because they didn't want to show any breakage in that income or that stability of income in that job. Well, it was discovered. Well, the big thing that we were able to work around it, we went only with his income, only with his job history. It wasn't a problem if they would have told us, but the thing is, a 1003, the loan application, is a federal document. Guess what happens if you lie on a federal document? The FBI, the alphabet boys come and look at you. They come and look, and then questions start being asked. Why did this happen? Why did that? This is not
unless you're in politics, then they
yeah. So yes, there are ways and there are things we're going to discover that my son's calling me. I can't take it right now.
One more quick question on before we leave this subject.
Yeah.
How do you answer when somebody said, and they say it, why would I share my 401k? That's my retirement stuff. It had nothing to do with me buying a house.
I totally agree. Totally agree with you, sir. But here's the thing. My job is to paint the best picture of Alan, okay? And Alan, when we look at rates, when we look at underwriting, when we look at the strength of the loan, I paint this picture of you. I want to paint it in the best light possible. And one of the most powerful things is, hey, we want to have reserves. We want to know that you have the wherewithal to pay for this mortgage if something does go for a little bit. If you've saved up, you have an emergency fund. Well, one of the best funds is a 401k. And what reserves are is actually your monthly mortgage divided into whatever reserve amount. If your monthly mortgage is $1,200 and you have $3,600, guess what? You have 3 months reserves. Anything over 2 months is strengthening that file and gets you a better rate. And it also gets you through underwriting on any other issue. That reserve pocket can help you get the loan instead of being denied. So sharing that 401k allows me to strengthen the loan profile without ever having to touch it.
Great.
That's how I talk with clients, but those great questions. Credit qualifying, again, right now in the industry, standard for the most part, 640 is the minimum score for FHA, VA, USDA, even conventional. And certain overlays by other lenders are a little bit higher. That is ours. But we're looking for also the debt to income ratio. What debt do you have off of there? That's where we get that liability listing. So we understand all the debt, jointly or individually. If you're filing with your wife or spouse, you're able to combine those. In certain loan programs, we don't have to have the spouse. But any governmental loan, FHA, VA, USDA, if the spouse is not on the loan, we still have to get the liabilities to get through. So that's what credit qualifying means. That's what why we have to pull the credit report. And it's generally the first thing done. Once we go over that hump, that obstacle, you get a gold star, we're moving on to income stability. Income stability really looks at 3 things.
That's a big one now.
You're laughing, huh? 2 years history,
yeah.
3 years future. We're looking at 1, have you had income for 2 years? Have you had a job for 2 years? And guess what, students? Being a student at the university can be a part. It's not it can be evaluated as a positive thing, not a negative. Does not stop you. But we look at income stability in the fashion of you've had a career, you've had a job for 2 years, you've maintained that stability. We see the income. How is it paid? Are you self-employed? Are you a W-2? Are you an hourly? Are you contract? All of these things come into play in income stability. How long have you been doing it? Is it in the same industry? So many questions come around this. Moving from self-employment to W-2 is much easier than moving from W-2 to self-employment. Comes up a lot. And the biggest difference is we can look at somebody that's coming into a company and being a W-2 employee from self-employed because we're looking at the stability of the company, not the individual. But if you're self-employed, guess what? We like to see 2 years tax returns. Why is that? Well, we want to see how you're writing things off. Here's an example that I often give to let people understand this. One of the hardest workers in our country are truckers, and truckers have shown their light in this pandemic time. Would you agree? They've done a great job. They've stayed working. Well, truckers can make anywhere from $300,000 to $400,000 a year. Very lucrative business. But when they get their CPA involved, guess what? What's their job? Well, we're going to save you money. We're going to have write-offs. Hey, we had to buy new tires. We have fuel that you're using. We have cost of keeping your truck running. We have, well, come to find out, once you go through all of that and the reported income that they report, they only make $32,000. It's amazing how it does. Well, guess what? Your base income is based off that 32, not that 400 or 300,000. You can't buy a home because any self-employed borrower is required to work off of their tax returns. K1s, S Corp, LLC, however it is, we have to base it off of those tax returns, not your pay stub, or because you don't receive a W-2. We have to base it on that. So 2 years tax returns. Well, somebody moving from W-2 to self-employment, if they don't have 1 year tax return, full 12 months in that job, guess what? They can't stabilize their income for us right now. We have to wait. There's not anything.
Okay, I have a quick question.
Yeah.
And this is real world stuff. I'm just trying to bring you what clients tell me when I'm with them.
Yeah.
All right. I made $32,000 after deductions, and I got $600,000 in my 401k.
Yep.
What do you say then?
I'd say you're going to put a lot of cash down.
Okay. I mean, that's the question. There's a disconnect out there with credit scores, continuity of work. Let's say if you're a nurse for 5 years and then you go into being a botanist, that's a discontinuance of the jobs you were in. I mean, I understand if you stay in the same business, then that counts. But if you change business, then there could be an issue. So
It's
a lot of times,
changed how you're paid.
When people, and this is primarily baby boomers or people moving into, or just right underneath baby boomer status. I don't make money. I retired. I got a little bit of a pension and blah blah blah, but I got money in the bank. And so, what do? Do they get to buy a house or not?
Well, they can still buy a house. It's if they're willing to use a lot of that collateral or assets available to purchase that. They might do a very large down payment or cash and only borrow a limited amount. We work off a fixed income as well, a pension, Social Security, retirement programs. We can work off, that's monthly income they earn. That's how people that have already retired go through a loan application, and we look at how long that pension is going to be available. How much do they receive? All of those things come into play. Just having cash, then you go into the cash side of the house. You don't need to deal with a mortgage. But if you want to borrow money, we're going to analyze the income stability of you. And that means you're receiving your retirement, receiving your social. Veterans, I'm called the DD 214 alumni lender. Guess what? You're getting a DD 214. You have a disabled vet. They're receiving disability income as well as maybe retirement income. All of that counts toward their ability to purchase because that's continued income coming into the household. And we count that. So we just have to prove that data up. If you receive Social Security or a disability from the VA, we look for an annual letter that you get every December that tells us what you're getting and how much over the next year. And that goes into that calculation. But having assets, like you're saying, a large 401k, that is still a part, but they may want to put a lot of cash down as opposed to being able to borrow against that. That may be a different type of mortgage, and those mortgages are not available at this time during the pandemic. Standard mortgages with Fannie, Freddie, Ginnie as investors. Those other investors, those outside, what's called a little hard money or non-QM solutions, are those certain solutions that are available for investors and other people that have unique ways. Hey, I'm already retired. I have a large sum of cash, but I don't want to put everything in. Here's what I want to do. And those programs are available, but it's not now, not during this.
Another quick question. Got clients. One deal went away, a great, beautiful home, and they were all set, but lost their job. Others I know personally are on unemployment and actually making a little bit more on unemployment than they were when they were working. But I tell everybody you can't buy a home when you're on unemployment. Please verify that.
Yes. Alan is exactly right. If you've been furloughed, we cannot use that income as a stable income. If you're on an unemployment, we cannot use that. Sometimes we can't even use child support. Child support is evaluated of 3 years. You have to be receiving or going to be able to receive it for up to 3 years or longer for it to be calculated into a loan mortgage.
Are there rules established right now today yet for those folks that have good jobs, were pre-approved before they lost their job, and have taken unemployment for, let's say they take it for 3 or 4 or 5 months, and then they get their job back and they're making money again? Is there such a thing as a penalty they're going to have to pay because they went on unemployment?
No, there's not a penalty.
Reestablish their, does the unemployment period establish continuity even though you can't do it while you're in unemployment?
Yes. We can't do it during unemployment, but as long as we reestablish normally 1 paycheck or 1 week of employment and a verification from that employer that continued employment is expected to happen, yes.
Is that a COVID thing or is that an everyday thing?
That's an everyday. That's a standard byline. There are no rules to coming off of this situation that they have made special for the COVID or pandemic that's going on now. That's the forbearance and the CARE Act is probably the worst thing that they could do for people because they didn't explain it. They made it very easy for them to do. And most people think it's like an educational loan. We're deferring it. We're deferring it. No, you're not. That challenge is that it's going to come due. When it comes due, you have actually hurt your credit. 1, you've gone into forbearance for whatever reason. And then 2, bringing it back up to snuff. Historically, only 1/3 of those people are going to come out of forbearance. 2/3 of them will never make it out because they don't have the money. And unfortunately, several of them thought, hey, I don't have to pay my mortgage for a little while. This is good. I can live and I can float on this. And I don't, not saving that money to pay it in a lump sum when it comes due.
And it's sad, I haven't talked about forbearance in being a realtor since 2000, maybe 7 or 8, whenever. It just kind of went away, and it sure has raised its ugly head. And it's sad because a lot of people are programmed about government relief and relief and relief, and it's what I try to say it politically correct because you have to be these days. Although I just tell them straight up.
Here, come on.
I tell them straight up, you're not being relieved. I mean, you're going to have to pay this back.
Yep.
And you have to pay it back sooner than later. So this is for people that legitimately have an issue. They can see the end of it. They can see they're going to get through it. They just need a month or 2 or 3 to get on their feet, but they got this covered. That's a great use of forbearance. Anything else, oh my goodness, they're gonna hit you up for a lot of money at once, and most people aren't going to be prepared for that.
As I said, a short-term game is going to be a long-term problem. It's just unfortunate that they made it so easy for people to get into it. And now if there's any way you can get back to paying your mortgage and not be in forbearance, please do so. Please.
And I've been using the analogy of fix-a-flat. It's exactly perfect. You get where you're going for nothing. You just throw in the fixing flat. But when you get to Discount Tire, $195, or you can't go anywhere.
Yeah.
So it's the same thing, and people need to put it in perspective. And I know there's people out there trying to make right decisions for their families right now. And that's why I think shows like this are important. Neither one of us are pushy. I've never pushed for a deal in my life. I never will. I want my clients to be happy, healthy, and I want them to enjoy the experience that we've gone through together. Same with you. Yep. And I think folks that watch this now are going to benefit greatly, in 6, 7, 8 months.
Well, I think this industry is going to be one of the key industries besides the energy industry in bringing back our economy. I think we're going to lead. I think the confidence that we're having. And that's where I'm saying the last 3 weeks, we've seen an increase in purchase applications going in. People are confident. People are wanting to make a move. So moving on, we've got credit qualifying. We're talking income stability. We look at 2 years history for 3 years future. Hey, W-2 income, If that's what I'm basing it on, that's all we use. We don't require anything else. If you have a secondary job, you have to have done that job for 2 years and reported it on your income, your federal tax returns, to receive benefit of that income. If you have not, guess what? It does not count. If you have 2 or 3 jobs, you need to be reporting them. You need to be receiving a W-2 if that's how you're paid. If you're an independent contractor, you need to have your tax returns completed. That is one of the hardest things, it seems, for people that are in the independent contracting or self-employment area to stay up with their tax returns. Please do that. That is such a critical piece of income stability, because we're looking at the stability of your income. How often is it coming in? Who it is? Realtors. You're not a W-2 employee. You actually are contracted. You are actually paid. You kill what you eat. You eat what you kill. So a lot of these opportunities require federal tax returns.
I feel tough right now. That was just.
Well,
yeah, it's like Mr. 1099.
Because that's the same way we live here in the lending world. So, hey, but so again, credit qualifying, income stability, and that's for both borrowers. If one borrower is independently self-employed and the other one is W-2, we're going to look at the tax returns. We're going to see how they're doing. If they're just both W-2, we only use W-2. There's no reason to go into it. The other aspects we're looking at it, we're going to get a verification of employment. What does that mean? A verification of employment means we're going to contact your employer and say, are they still employed? And we're going to ask the day before you close if you're still employed. It's just like that veteran that got deployed. And I guess what? I have to call or I have to get an email from the commander going, yes, this veteran is still alive as of today. Even though, the process is going on, they got deployed in the process. We have to get a verification of life in a VA world. So right now in the pandemic, we require that the day before you close, that employer still has to say you're employed. If you're self-employed, that means we have to get something from your CPA. Yes, this business is still afloat and it is expected to be. We still have to receive that from the CPA the day before we close, not just in the process time, but we also go into the day before. Okay. It's very critical in the changes that are happening in the industry. The requirements are changing and that we have to stay up on. So income stability, that's how we evaluate that. Documentation we use, tax returns, W-2s, Social Security letters, pension. Of course, anything dealing with pay stub, your most recent. Some people require 2, some people require 3, some people require however you're paid if 1 month's worth. We want to see that documentation that supports that you're employed and receiving income. And that's for as many borrowers that are on the app, co-application, applicant or co-borrower, borrower. So income stability is critical.
So that's another big thing in the real world. You typically run into let's say a husband and wife, and husband doesn't have credit, wife does. And yet husband makes more money than wife. Let's just for an example. And a lot of times it's the other way around, but yeah, it is. And it's like, so where does that go? Because I always, everybody, well, we make this much money. Well, you also have a 520 credit score.
What we do generally in a situation where we have 2 borrowers, one borrower is hurting in credit, the other borrower makes way more money. Unfortunately, we can't utilize that income without having the credit scores. So if we have, let's say, one borrower is not good credit, not enough income, but we can do it all on one borrower, that good credit income, we do that. It's a conventional mortgage. But if we have to use, then we have to work on the credit score of the other. And we go into a credit repair or a credit situation to get their scores up. If they're 50 points away, I recommend going to a credit repair specialist or a professional that allows you to know what they're going to do, understand what's the problems and how to attack it. But if you're only 2 or 3 points, there might be things we can do. Simple things. Hey, ask for an increase in credit on your revolving credit cards. That adjusts the ratios very quickly and can increase scores, can change them positively. That's how this Boost. You see this commercial out there talking about Boost. Well, that's what they're doing. They're changing. They're asking for increases in credit, or they're asking for a quick payment early, or you're paying it differently. The bottom line is we can move credit 8 to 20 points sometimes. But if you've really got numbers, you really have to work on it. I request you go to a professional. But normally we can get by with one of the borrowers. We change that to a conventional mortgage, and we base it just on their income and just on their liabilities. We don't have to take in the other's liabilities.
So in real people speak, when I explain it, they'll say, well, I make, X amount of money. And I said, well, obviously you spend a lot of money. I said, so the way lenders look at it is it's a collateral situation, and it's a situation where you're dangerous. You make a lot of money, but you spend a lot of your money. Well, what do you mean? Well, what I mean is the more you spend, the less you have to go towards the purchase of a home.
That's right. And how far are you leveraged? How far is the back end, the front end ratios?
So you have to have these real type conversations with people and put it in real words.
These are conversations I have every applicant, because I want to sit down and help everybody understand where they stand on credit, where they stand on income, how tight it is going to be. Because when I give you a pre-approval and say, hey, it's going to be a little tight, but we could do this, this, or this, seller credit, lender credit, or premium pricing, or we need to make sure we get this. There are ways that we can work around it together. That's why the relationship with the realtor, client, and lender are so critical. But again, you don't know where you're at until you sit down and talk with somebody. Even over the phone, I do a lot of video conferencing right now. I've become almost a wizard on these different platforms somewhat. But understanding where you're at, what you can do, and there's some simple things again that you can do. I just got off the phone with a refinance, and the one thing on the liabilities was the wife was on a joint account with her parents because they wanted to help her score raise, but it's not her card. And the card is maxed out right now. Well, that maxed out liability impacted their ability to buy. What is the simple change? Take her off. It wasn't that hard. It dropped her scores a little bit, but we had room. So take that liability off. All of a sudden, they got pre-approved to be able to refinance what they were doing. And they were able to do some of the things. But it's, again, we don't see that because we probably haven't touched on it. We haven't seen it. We haven't talked about it until you talk with a professional that knows. That's the big thing. So, again, credit qualifying, income stability, a critical piece. And right now in this market, we've got to make sure, even if a client or a borrower is furloughed, we cannot do a mortgage on a furloughed employee. Now, furloughed means they're still employed. They're just time off. And if they don't have the holidays or so forth to use, they're actually without pay. And being furloughed, that is not being employed in our eyes. So understanding that, I've got one client, he's going to be furloughed. We know it, but I'm able to do it just on her income. So again, understanding that situation, knowing everything I can do to help out a client. That's why we don't want to hide things. As you brought out earlier, hey, I got a 401k. I don't want anybody to know about it. That's none of their business. No, it's not. And we're not going to try to use it, but it is your benefit to maximize your loan.
Another reason these shows are important for people to look at or watch or listen is, again, real world. They're pounded 24/7 on media.
Yep.
Anybody can buy a house. Call us. And, these people that, they love you. We love you. Come get a loan. We'll do it in 8 days, that kind of thing. So, of course, they generate a lot of phone calls. And from there, most time it goes nowhere. But they just do so much volume on this stuff. So the people that I talk to, there's a couple. There's investors. They'll call up and do you have any off-market properties? And I said, are you bird dogging for an investor? Yeah, how'd you know? I said, well, what class did you go to? Because you missed a step. Well, how'd you know? So because I hear it all the time. And, it's the same thing with people think they can get a loan with a 580 credit score or a 600 credit score. They hear it somewhere, and that's all it takes. And then you get the call, which I love to get the call, we want to buy a home. Okay, great. Well, then when you get them to somebody, like you, and you go, no, they can't, they're not qualified. Well, that's tough. And there's a lot of people like that, and fortunately you do such a good job at getting them the right direction. And I try to think I do too.
Well, and I think if we look at things in the way that we look down the road, I try to encourage people, hey, find out where you're at now so that down the road, 3, 4, 6 months from now, you're going to be in a position to buy, because I'm going to be able to tell you what you're going to need to do. Or do you need to change anything? Or can you even buy now? But the bottom line is, let's do it on a basis of knowledge. Let's not do it on a basis of assumptions that I've heard it. Hey, I was pre-approved 2 years ago. I could do that. I should be able to do a $300,000. Oh, really? Did you own this RV, and did you own the boat, and did you own the 2 ATVs before that or after?
It's always amazing to me. I look back every year, and there's always 1 or 2 people that I've helped buy a house that I've been working with for 2 or 3 or 4 years. And at the beginning, it was like, you sure you want to waste your time with us? I mean, no, this is exactly what I do. It's not a waste of time.
No.
And I tell you what, that is so cool when you hand them the keys. They've done what they needed to do. So if you're out there and you're thinking of buying a home, you just, I know it's tough times right now, but we won't be in tough times forever. This is going to be past, and you're still going to need to provide for your family and buy a home. And there's help out there. It takes time sometimes, but don't give up, because it happens. It's very positive when it happens, and it does happen.
And work from a source of knowledge as opposed to a source of estimates. Work from already talking or working with somebody that you trust. I just challenge you. There's so many things, so many ways that you can continue to trust and grow that. And I mean, I've worked with clients for over 2 years. They were self-employed. We had to wait on their tax returns to be set up. But you know what? That 2.5 year time, we were able to get them in the home at the program that they desired. It was awesome. Now, some of those programs, bond programs, are not available right now, but they will come. As Alan said, we are not going to be stuck in this situation.
And the opposite of this was just a couple of years ago. You'd had bunches of people pre-qualified, ready to buy, but you couldn't get a house. There's 10 offers on every home, which means 9 really upset buyers.
Yeah.
And that is almost a worse scenario, because people just give up. They're qualified, but they're like,
don't they? How many people gave away that they were pre-approved, but the rent race is wanting them to get out, but then they can't end up, we get outpriced by an investor. They get, my son-in-law just sold his house, $15,000 over asking.
Yeah.
Got a signed contract. I told him, don't expect it. The appraisal may come in short, so be prepared. But I was amazed. They got 4 offers inside of 6 hours and $15,000 over asking.
Well, everything is relative. A house is worth what somebody will pay for it. If he's got something people want, then it's going to happen. But the point I want to make is, all the people out there, this is a great time to get pre-qualified to buy.
Great time.
I'll tell you who's going to buy the houses if you don't, are investors. They're already buying homes. And I just saw today a big company bought an oil field. Well, when do you buy stuff? I remember the president of our company, when I started out in business years ago, the president of our company was giving a speech, and he said, we got a lot of our equipment when the 1987 thing hit. Things went down, stock market kind of crashed, business went out of business. He bought all the equipment. And I'm telling you, people with money make money at times like this. So if you have the money and you can get pre-qualified, the deals are really good. Now, what Blair said is true. There are homes out there that are always going to get above list. There's a couple reasons for that. 1, they got something a bunch of people want. 2, it might be priced right, and maybe it's worth more. Or 3, it's just that special and in that unique of an area. Generally, that's what it is. But in general, that's not the case. Right now, there's inventory out there. Market values are fair. And don't tell any lenders, but appraisers tend to not catch up very fast on appraised value. So we have that working for us too. So if you are looking at it, call Blair up right now, get going, get started, text me, call me, buzz in right now on this, and, check it out because it's a good time right now.
Rates are unbelievable. It is a great time to purchase. Diane, thank you so much for your feedback. Appreciate you listening. It is a great time to be looking and to be aware of where you're at, to be aware of what you can do. And there it is. There is my email address or my phone number. As Alan said, please give me a call. I'd be glad to answer any questions or talk. Now, the third area, we talked about credit qualifying, income stability, and a fourth, the collateral at the home once we get the contract from Alan. But the third area is asset affordability. Mortgages cost money, okay? But there's closing cost, and that includes several things. Prepaids. Prepaids are divided up into escrows. That is your property tax. That is your house and home insurance. So we prepay those things. Unless you're in a conventional mortgage and you have 20% equity or more, you can have the alternative of not getting or denying escrows. Otherwise, you're going to escrow those, and we collect escrows early. Generally, on a purchase, we collect 2 or 3 months, depending on where we are in the year, on how much we collect. Normally, that's all that is a part of that. Then you have your cost of the mortgage itself, title, your underwriting, your processing, all of that, the escrows, whatnot, all goes into it. So we have closing costs that we have to come up with, along with the down payment. That is the third area, the down payment, depending on what type of program. I love the VA program, 100% financing. We can do, can you believe it right now? We can do $1 million at 100% finance through the VA right now in certain situations. It's unbelievable. And we even have the ability in certain situations not to have to escrow in the VA world now. But there's opportunity out there, and rates again are unbelievable.
And again, that's the biggest thing that a realtor hears out there. Oh, I don't have the down payment for a house. I mean, I'm not ready. And of course, anybody that's been in the business a while, you'll start asking them questions, and it's all about somebody's desire. But if they have the desire but don't think they're ready, then I can deal with that 99.9% of the time.
Yep.
And so don't hesitate. If you're, even if you're not quite ready, but you still think you have a problem with down payment money, now's the time to discuss it. Let's get after that. And I assure you, we'll come up with something that is right for you. There's so many different loans out there. There's programs out there to help people with down payment assistance. There's a lot out there. So
asset affordability generally is one of the easiest ways to work around, but we will need to see checking, savings, 401k, pension, anything that is asset or potential liquidity for you. And how do we check that? Well, we look at bank statements. We normally require 2 months most recent bank statements on any account, checking, savings, multiple checking, multiple savings. And the things that we're looking at there, not only is the balance, is your name on the account? How many times have I had it suddenly, wait a minute, you're drawing from an account that it has your name, but it has your dad's name too, or somebody else's? I have to get verification of that, and that those resources or the funds available, they're really your dad's, and he's just helping you out. We need to understand that. How much is really available for you to use? We go into one of the things about bank statements that people don't know. You know what an NSF is, Alan?
I do not.
NSFs, we look at NSFs on bank statements that talk about non-sufficient funds. When did you get financed by the bank because you overdraft your account? And how many times does that happen? Well, guess what? In a 6-month period, it only can happen once. In a 12-month, it only can happen twice. If you live off of that, and I have met many people meet every other demand around, but their assets on their bank statement, their only checking account that they have NSFs. Well, guess what? That means you're being financed by the bank already. We can't utilize that process. We have to deny those assets availability for use, therefore deny the loan. So you want to be aware of what we're looking at. Again, checking, savings, we want to look at bank statements, 401 account, pensions, we want to look at those quarterly or annual account status. And we want to make sure that your names, account numbers, all of that are on there and they equal out. My biggest job in the industry, lenders won't tell you this, but real estate is the largest fraud industry. We want to make sure you are who you say you are. You're using your funds personally. And we want to make sure the drug money or anything is not being cleaned or, washed into the industry. Therefore, we have to validate. A gift is possible in assets. You can receive a gift in any mortgage loan program. So a gift is from a friend, a family member, somebody that wants to help you. You can also receive seller credits. A seller credit is actually the seller giving you, and that's different percentages, but normally in FHA it's 6%. The VA world is 4%, and of course it can range from 3 to 9% in a conventional world.
And when they say giving you, that just means you're able to borrow.
You're able to get that money from the seller to help you pay your cost to close the deal.
But the home still, on an FHA, has to appraise for the increased amount. The seller is willing to take less money, but typically we just raise the price of the home best we can. So that's how that works.
And so, again, there's ways to do that. There's another way that's called the lender credit. And normally when you're doing a lender credit, guess what you're doing? You're actually premium pricing the rate. You're actually going to take the rate a little bit higher, and you're going to get a percentage of that money that you're out of, that you're paying toward it, back to you. So it's really your own financing. Now, again, assets is one of the easiest ways to work out. Alan said it. We will work out a program. Bonds, down payment assistance are very hard right now. They're very stringent. They're not going to be as readily available as they were, but they will be coming back. But there are other ways to work the asset affordability area. So I hope we have really gone over a lot here. I want to go back over credit qualifying. We check out all your credit scores, all your liabilities, your history. We check out who you are, how many different aliases you have. All of that goes into credit qualifying. Then income stability. How much are your income? How stable are you? Are you W-2? Are you self-employed? And then finally, asset affordability. That gets you to the pre-approval process. Finally comes Alan. He gets a contract on a wonderful home, the home you want. And then we bring in the collateral, the home itself. Now, Alan, real quick, I hear a lot of confusion, and we've only got about, I think about 12 minutes, maybe less. But people ask, what's the difference in inspection to appraisal? And I generally try to tell them an inspection's just for you. Would you help them? What is an inspection for? Why would you do it? Why would you not do it?
Well, once we're under contract, we go into what we call an option period, 7 to 10 days. That protects the buyer from buying something they don't know is not a good thing to buy. So inspector, they'll hire an inspector. Inspector will come in and he'll look at every aspect of the house from the top down to the bottom and the insides. And it protects everybody. Appraisal is totally different. It's a lending thing. And,
yes, it is.
Appraisal,
we do an appraisal no matter what. There has to be now. I have to say I am getting a lot more appraisal or inspection waivers, appraisal inspection or property inspection waivers on this right now. But the bottom line is
hold on just a second. Explain that real quick.
Okay. In a contract, you're buying a home or you're refinancing. The lender is coming into an agreement with you. So therefore, the lender wants to make sure, hey, the collateral is worth the money we're loaning. And so we want to get a value on a property. We want to get a solid value on a property. You tell me it's worth $500,000 and it's really worth $200,000. That's how the market blew up back in, 2008? Somewhere in there?
Yeah, somewhere in there.
We want to appraise that value. We want to evaluate. Now, property inspection waiver means the MERS data is very solid in the loan application. That means Fannie or Freddie identify, really Fannie. And what they say is, hey, we agree with that property value that you put on the loan app. We agree with that, and we do not require an appraisal now.
And that's why I wanted you to go over that, because totally different than in my end of the business. If I'm helping you buy, I will advise you 100% of the time to get an inspection. Forget the appraisal part. Let's get the inspection. We walk into a house, we see how we like it. It's good and everything like that. But what we can't see, we need to know.
Yep.
What's going on in the attic? What's going
Alan
on in the electricity?
wants to know if it's lipstick on a pig or if it's the real thing. That's all.
Well, it's an important thing, and you're going to sign something that says you got the property inspected or you decided not to, because you're going to be responsible for that as a buyer if something goes wrong.
Amen. So an appraisal evaluates that value, and that we come alongside of you and agree that's who we're going to be servicing your loan. So we're agreeing to buy it with you. You own the property. You decide in so many ways, but there is requirements to how much you pay back and how much we're willing to lend you based on the collateral. And that collateral comes into play. That's a full loan application, a 1003. When we have that, we have an application we can execute along with a contract, along with all your documents. And boy, it can happen, and you can own a home shortly. So I hope the show has been very valuable. It's been a great time sharing with you on a 1003. And I can't wait. Next week, we're going to be talking about the contract. We're going to be talking about Alan's side of the house. We're going to be talking about what goes into that contract. How is it set up? What are the importance of it? Why is this here and not here? Why is that a no? That is a yes. I look forward to that conversation next week as we talk about the TREC contract when you purchase a home. Any comments left, Alan?
No, I think you did a good job on explaining the lending side of it. And next week we will talk about the real estate contract. We won't get legal because none of us are lawyers, but lawyers write it and we fill them out. So we'll discuss them. We'll have a copy of it with us. We'll go through it 1 through 25.
Oh my gosh. I only had 4 guys, so please.
They're a lot shorter. A lot shorter.
Hey,
a lot like that.
Hey, I'm Blair Thomas.
Hi, I'm Alan Pace.
God bless everyone. Have a great, safe time out there. Stay safe and look forward to hearing from you next week. Take care.
Bye-bye.
Mark? 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 Hello, Mark?
I can do that too.
Yeah. I don't know if he wants us to drop off or what. I thought he'd be closing it up.
Well, I think you ought to still keep talking about lending. I think we're still on.
Well, we are. Wow. Yeah. I don't know how much more the
well, there is one more thing if we're still on, and if you guys can hear us out there, the pre-approval process now is no different than it was pre-COVID. I get asked that a lot, and I wanted to make that very clear. It's no different. Our lives have changed. Some people have been furloughed. Some have lost jobs. Others are, as in many states, being called back to work. And we all are going to be back to normal at some point. So we are no change on pre-approval, no change on going to buy a house. There's ways to get in and see it cleanly and safely. And it's not just virtual. Like everybody says, everything's virtual now. It's not true. We go out. I'm going out this evening to show a beautiful home to a great couple. So nothing's changed as far as pre-approval process, and buying a house right now is a great thing to do. The timing is perfect.
Well, I agree. Rates are going to be staying the same. They have flatlined. They haven't moved very much. It's a great time to buy. And actually, with these rates, you're actually getting a little more home than you probably would in the past. And so talk to us, call us, give us a chance to help and let us know. And I'm going to go ahead and leave the studio, sir. Alan, I don't know where Mark's at, but.
Well, I'm just going to say one more quick thing before you leave.
Yeah.
We'll challenge some folks to call in and type in their questions, and not next week, or maybe next week too, but during these things, so that we can answer what people have on their mind, not just what we have in our mind. And I think that's a good, real estate lending and learning. It falls right in line.
I agree with you. And I should have said more about that you can type your questions right there in the live comments and we would have responded. So.
All right, brother. Well, you have a great day. Thanks for listening, everybody.
You have a safe one out there too. Okay.
Okay.
Take
Bye-bye.
care. Bye-bye.